Okay, so let me ask you a question. What if the safest, most recommended way to invest for your retirement was actually a ticking time bomb? I know it sounds dramatic, but that's the core of a massive debate happening in finance right now. It's all centered around passive investing. We're going to unpack the arguments on both sides, and believe me, they are compelling.
So this is the big question, right? Has the go-to strategy for steady, long-term growth somehow turned into a huge systemic risk? We're talking trillions of dollars on the line here. The answer could affect the retirement accounts of millions of people, maybe even yours.
All right, to really get a grip on this debate, we have to understand how we got here in the first place. You see, the rise of passive investing wasn't some overnight thing. It's been a slow, powerful shift in how millions and millions of people build their wealth.
So, what is passive investing really? Well, the idea is pretty simple. Instead of trying to be a genius and pick winning stocks, you just buy the whole market, or at least a big piece of it, like the S&P 500. And you can see the appeal, right? It means lower fees and you're instantly diversified. It's an incredibly popular strategy, but it's the sheer scale of it that has some experts really starting to sound the alarm. So let's dive into the first side of this argument, the case that we are, in fact, living inside a massive passive investing bubble that's dangerously distorting the entire market. Here it is, the core of the critics' argument. As all this money pours into index funds, it automatically buys the biggest stocks out there. Think Apple, Microsoft, you know the names. And it does this no matter if they're a good value or not. The funds buy them just because they're big. And this creates a kind of feedback loop where size, not fundamentals, is what's driving stock prices higher and higher. And this creates a really powerful feedback loop. You see, as the prices of those top stocks go up, more money flows into the index funds. Those funds are then forced to buy even more of those same top stocks, which, you guessed it, pushes their prices even higher. Critics are arguing this whole cycle has become completely detached from reality, inflating a bubble based purely on momentum, not on actual performance. Now, this kind of self-reinforcing cycle leads to some very real dangers. First, you get these inflated valuations, where stock prices soar way beyond what a company's actual earnings can justify. Then, the market sort of loses its ability for price discovery, meaning it gets harder to tell a genuinely valuable company from one that's just, well, big. This creates an extreme concentration risk, with the entire market's health depending on just a handful of giants. And the biggest fear of all, what they call cascading sell-offs. If people start pulling their money out, that whole cycle could reverse and turn a small dip into an absolute nosedive. To see just how stretched things might be, just look at this number, 38. Now, on its own, it's just a number. But when you put it in the context of stock market history, it's a major, major red flag. So that number, 38, that's today's Schiller PE ratio. You can think of it like a long-term price tag for the stock market. It compares current prices to the average earnings over the last 10 years, adjusted for inflation. A higher number means the market is more expensive. And right now, that price tag is more than double its historical average of 17. This is one of the strongest data points suggesting the market might be significantly overvalued. And here's that concentration risk I was talking about, plain as day. The S&P 500 is supposed to be this broad basket of 500 different companies. But right now, just the top 10 companies make up a staggering 40% of its total weight. I mean, think about that. It means if just a few of those giants stumble, they could take the entire market down with them. This quote really gets to the heart of the fear. The idea is that in a downturn, those same passive funds that were forced to buy on the way up would then be forced to sell on the way down. And that could turn a simple market correction into a full-blown crash. It's a pretty scary thought. Okay, that was a pretty convincing case for a bubble, I have to admit. But now let's flip the coin and look at the other side. Is this whole argument just overblown? Are there other forces at play that are keeping the market in check? First off, let's get some perspective here. Passive investing isn't some new fad that just popped up. The very first index fund was launched way back in 1976. This has been a slow, multi-decade structural shift in finance, not some sudden, irrational mania. And that long history suggests its effects are probably more deeply integrated and maybe less explosive than the critics claim.
And let's zoom out for a second. While passive investing is huge, it's still just one piece of a much, much larger pie. Globally, passive strategies only account for about 20% of all assets under management. The other 80% is still being managed in all sorts of other ways, and that provides a pretty significant counterbalance. And even if we zoom right back in on the US fund market, the numbers might actually surprise you. Despite all the headlines you read about the death of stock picking, active funds, the ones where managers are paid to find the best investments, they still control the majority of assets. The big takeaway? Yeah, passive is growing fast, but the world of active management is still very much alive and incredibly influential. And this brings us to the key counterargument. Price discovery isn't dead, not by a long shot. There are still legions of active investors out there, hedge funds, portfolio managers, individual traders, who are trading billions of dollars every single day based on deep research into company fundamentals. Proponents argue it's their activity that truly sets market prices, not the supposedly mindless buying from passive funds. All right, we've heard both sides of a very complex, very important argument. So how do we put all this together? What should you, as an investor, or even just an interested observer, really take away from this whole debate? So really, we have these two competing views of the market. The bubble view sees a system where popularity is driving prices, not the underlying value of a company. But the counterargument says that, no, active investors are still setting the prices, and that's what keeps everything in check. The truth is probably that both of these forces are at play, creating this constant tension that really defines today's market. So, what do we walk away with? Well, first, there is absolutely no question that passive investing has profoundly changed the way the market works. Second, those concerns about high valuations and this top-heavy concentration, they are totally valid and something we should all be watching closely. But third, it's also clear that active investors still hold enormous power in setting prices and, keeping the market honest. Ultimately, understanding this debate is really about understanding the powerful, competing forces that are shaping your own investments every single day. And that leaves us with one final question to chew on. Is this powerful trend just a more efficient engine for our modern financial markets? Or has it introduced a hidden, unpredictable element, a kind of ghost in the machine that we don't fully understand yet? The answer to that question will likely define the next decade of investing.